Everyone says rate cuts make Bitcoin pump. The data says it depends. Today you will get the full macro playbook. 3 top signals that I use in order to know if the rate cuts are going to be bullish or bearish, charts and case studies so you will never have to guess again. What's up everybody, welcome to Bitcoin Predator, hit the like button and subscribe. Rate cuts dominate headlines, but if you trade Bitcoin on headlines alone, you are gambling. In today's video, I'm gonna teach you the top signals that I track before, during, and after the rate cut. We'll walk through the why behind each case and some data sources that you can use in order to understand if this is going to be a bearish or bullish rate cuts, as well as real case examples where traders got it right and where they got wrecked. So guys, before we dive in, we have to first understand why the Fed cut rates. And in simple terms, the Fed cut rates in order to make it easier for the general population, businesses, corporations and so forth to borrow money. When the population and businesses are able to borrow money, that means that there is more liquidity flowing into the market, which drives the economy's growth. However, some of you know already that the biggest job of the Fed is a dual mandate: to keep inflation under control while at the same time keeping the labor market healthy. But there is a caveat when it comes to cutting rates by the Fed, which is the real interest rates. And why the real interest rates matter so much? It is because it shows the opportunity cost of holding cash against risk assets. And you can summarize the real interest rates with a real simple formula, which is interest rates minus the rates of inflation. The interest rates, as you know, is already what the real, the mainstream rates that the Fed establishes in the US, which right now, since April 2025, is sitting around 4.33%, also called the federal funds effective rate. The rates of inflation, on the other hand, is what we call the US PCE price index, and right now it's sitting around the 2.6%. So the real interest rates is the interest rates minus the rates of inflation. In our case right here, if you take those numbers, that's going to be 4.33% minus 2.6%. The real interest rates then is going to be sitting around 1.73%. And this can be tracked by the real interest rate from the Fed chart right here. And this is where actually the game is played. By looking at this chart, you are going to know if, when the Fed cut rates, if it is going to be bullish or bearish. Let's take a couple of examples here. First one, let's talk about the bearish cases. The first one took place at the dot-com bubble burst. At the end of the 2000s, the Fed decided to cut rates. However, the market on the S&P 500, for example, dropped at around 10% until 2003, when it started to get traction back again up. And if you take a look at the real interest rate at around this time, back right here at the end of 2000, it was above 0%, sitting around 2.5% or something like that around this time right here. And when the Fed started to cut rates, actually, even though many people believe that it's going to be bullish, it started to decline. The thing is, when you start to cut rates, you actually start to create inflation on risky assets, which can also drive the real PCE price index up. And that's why, although the interest rates were going down, the real interest rates was still above zero. And that's exactly why the market kept going down. Another bearish case that we can remember right here is the 2008 financial crisis. By the end of 2008, that's when the Fed started to cut rates, and as you can see right here, a huge drop in the market on the S&P 500, and only at the beginning of 2009, the market started to grow back again. And again, right here, at the real interest rate, it was above zero. Even though we had rate cuts, the market was not healthy enough in order to go bullish, and it started to go down before recovering at 2009. Now let's talk about the bullish case. When was the good time in order to cut the rates in which the market would go up? And one of those examples, although was not very good for humanity in general, we had the COVID-19 situation. At the end of 2020, the Fed started to cut rates. And as you can see right here on Bitcoin, it was actually started to go parabolic. And guess what? Right here at 2020, the real interest rates were below zero. So the rate cuts drove the market bullish. So bottom line, as we can see right here, if the real interest rate is below zero, most likely the market will go up once the Fed starts to cut rates. However, when I looked at the charts, I noticed that it doesn't happen immediately. And is not also the case for the bearish markets. Sometimes, even though the real interest rates are above zero, actually, we can still have some pump before starting to go down. And this is exactly what I'm going to talk about right here on the top signals that I check in order to have an idea if we're going to become bullish or bearish. And the first one that I'm going to talk about is, of course, the real interest rate. So if you have been following this channel for long enough, you know that the pressure on the Fed in order to cut rates has been growing tremendously. The labor market has started to feel a lot of impact, and even though we still have some inflation, the Fed has to cut rates on September. Right now, if you check the chances of a rate cut in September is sitting around 84.6%. So the real interest rate is consolidating below the 2%, and I do hope that it gets way below 0%. And quite honestly, unfortunately, I don't think this is going to happen. I think we are still going to be above zero. But this is not only bad news. There is something else that I'm going to check if I want to know how much bullish or bearish we are going to get. The second signal that I'm going to get is the M2 Global Liquidity Index, but most importantly, the M2 growth rate. So imagine this, the M2 Global Liquidity measures how much liquidity is flowing into the market. However, the growth rate measures if that liquidity is increasing or decreasing, which is as important as the M2 Global Liquidity Index with an offset. So whenever the growth rate is reaching close to zero or maybe below zero, this is when I'm most likely to notice a decrease in Bitcoin price. However, if I see the M2 growing over time and way below zero, that's probably bullish for Bitcoin. Alongside with the M2 growth rate, I'm going to check the bank credit expansion, which in a similar way measures if the credit issued by the bank is expanding or shrinking for the general population, which in turn is going to get more or less liquidity into the market. And as you know, more liquidity for Bitcoin actually increases its price. Lastly but not least, I'm going to check the ETF inflow. So pretty much ETF inflow is retail and institutional capital flowing into the Bitcoin market. If we still notice some inflow of money for Bitcoin, this is actually quite bullish. But here's my take. Even though we are not below zero on the real interest rate, if we still have a lot of liquidity flowing into the market, it means that Bitcoin price will still spike. However, the trick comes on how many rate cuts we are going to get before starting to go bearish. Because yes, on the first rate cut, yes, I believe the price will go up. Maybe on the second. However, once we have a confirmation that we are about to hit a recession and the real interest rates are still above zero, I think during the year of 2026, we are going to go bearish on Bitcoin, confirming the end of the bull cycle for this year and the beginning of the bear market on 2026. Let me know what you guys think in the comments. Thanks for watching. See you in the next video.